Hey, Dwayne, can you hear me?
I can hear you.
Oh, perfect. I don't see a lot of trustees yet.
I don't either.
Can you guys hear me?
I can hear you.
Yes, I can hear you also.
You're muted, Patrick. There you go.
Jill, can you hear me?
Yes.
Hey, Jill, can you hear any of us?
Can you hear me now? Testing 1, 2, 3.
Yes, I can hear you.
Perfect. Great. Thank you, Valeria.
Can you guys hear me?
There he is.
All right.
Thank you.
Good morning.
Morning. Do you guys have the valuation report in front of you or no?
Yes, sir.
Oh, perfect. So there was a lot of things going on this year. But in the end, the city's costs went down quite a bit. If you're looking at page 6 of the report, you know, every year as of October 1st, we look at the assets in the pension plan, and then we project out
Excuse
all
me,
the,
Patrick, excuse me. I'm sorry, did we call the meeting to order?
Probably not. We took roll call.
Yeah, we took roll call.
Okay, I didn't hear that. Okay, I'm sorry.
See,
Sorry, Mr. Brown. My mistake.
do
okay,
you guys want to open the meeting first?
sure.
We'll start, we'll call the meeting to order at 10:10. Roll calls are been established, Ms. Jill established roll call. We approve and accept the minutes as read with the change to Mr. Larry being present. And the minutes will be corrected by Ms. Jill. And then now we're on to Mr. Patrick, if you will, evaluation report.
All right, yeah, so every year we look at the assets and the liabilities and determine an appropriate funding requirement. And so we always do it 1 year ahead so that the city can budget. So for the right-hand column on that page was our valuation as of October 1, 2021, and that determined the funding requirements for the year we're in right now. And then the left-hand column looks at everything as of 10/1/2022 and determines the requirements for the year for next year that starts 10/1/2023. And you can see the total required contribution went from 51.2% of payroll to 41.3% of payroll. After you take away the members, the city and state goes from 45.2 to 35.3. And then the state monies were 61,250 this year, which right now represents 4.3% of payroll. It may not be that exact amount for this year or next year, but that's our best estimate. And so with that estimate, the city's required goes from 40.9% this year to 31% for next year. And there's a lot of different reasons. Part of it is because we do that calculation each year of how much the excess state monies can pay for in a multiplier. And that amount went down this year. So the benefits for the firefighters starting 10/1/2023 are going to be lower than they were now. And that reduces the funding requirements for the city. That's part of it. Part of it is that you guys hired new firefighters. And so the payroll of the department is higher now. And so if you take some of our fixed costs, like the payment required to amortize the unfunded or the administrative expenses, those types of things, if you increase the payroll, then those are now a smaller percentage of payroll. So that was part of the reason. Another reason the cost went down is that you had a lot of turnover. You had 4 firefighters terminate non-retirement during the year, which is quite a bit more than we expected. And that reduced your funding requirements. There was 2 things that increased the funding requirements, and one of them was the investment return. So why don't we go to page 31 for that? So for this actuarial valuation where we determine funding requirements, we can use an actuarial value of assets. And you guys started over with a new smoothing technique 2 years ago. And so basically each year we look at what we expected to earn and what we actually earned. And that difference is the investment loss or gain for that year. And basically we're going to spread that out over a 5-year period. So if you look, right, it goes down just a tiny bit, Jill, where it says development of investment gain or loss. And it says that 10/1/2021, you guys had $9.9 million in the plan. So you basically had $10 million in the plan. And our assumption, our expectation is that we're going to earn 7.5% on that money. So basically $10 million, expect 7.5%. We expected to earn $748,000 during the year on our investments. And in reality, we lost $1,673,000. So it was a horrible year for the stock market and the bond market. You know, your plan is no different than any of my other plans. So your return was minus 16.95%. So basically we missed the mark by 2,421,000. You know, we expected to earn 748,000. We actually lost 1.6 million. That's a difference of $2.4 million. So back in the upper left-hand corner, then we're going to only recognize 484,000 of that loss this year. And then in 2021, we had a big gain. So we're recognizing 20% of that gain each year. So with all the smoothing, we only had a loss of 236,000. But if we were using the market value with no smoothing, we would have had a loss of 2.4 million. So the good news is, you know, we helped smooth it out. But the bad news is, you know, we're going to be hurt next year, the year after, the year after, and the year after, you know, because we're deferring some of those investment losses from this year. Does anybody have any questions about the asset smoothing?
Patrick, you said that this plan was different than your others.
No, I said no different.
Oh, no.
I said, I said, you guys, you know, you lost 16.95%. And the average of my plans was probably about 16% loss. So that's what I meant when I said, you know, you had this big loss this year, but that was no different from any of my other plans.
Okay, thank you.
So that was, you know, an unusual year where we had such a big loss on the investments. And so that caused an increase in the funding requirements. Then if you go to page 37, that's your turnover. And again, this was unusual turnover for the year also. So at the beginning of the year, you had 21 non-drop firefighters. You had no one in the drop. So you had 21 firefighters as of 10/1/2021. And then you had 2 people terminate vested. So they're going to draw a benefit down the road. And then you had 2 people terminate and then take refunds of contributions. And we only expected about 1.3 firefighters to terminate during the year. So, you know, those people that terminated and just took a refund, well, they were a gain to the plan because all the city money and state monies, that all stays in the plan. The member only gets a refund of their own contributions. And the vested deferred members were also gains because, you know, they are going to get a lifetime benefit, but they're going to have to wait for it. And it's going to be based on a smaller number of years of service than if they had continued to work and draw a full normal retirement benefit. So, you know, you had gains, quite a bit of gains to the plan because of the high turnover this year. And then the other thing is, you know, you had 4 people leave and you hired 8 new firefighters. So you went from 21 to 25 firefighters. So that's what I said at the beginning of the conversation is that your payroll went up. You know, your overall department payroll is higher. And that actually reduces some of the costs as a percentage of payroll. Does anybody have any questions about the turnover page? So then if you go back a little bit further, Jill, to page 47. So that's the worst page in the report because that's the accounting of the plan. If you scroll a little bit further down, Jill, the net pension liability, which was 1,526,000 last year and 3,832,000 this year. That's the liability that the city puts on their balance sheet for the pension plan. It basically says, okay, you know, you have this pension plan and you have an unfunded liability. And that went from 1,526,000 to 3,832,000. And if you remember, you know, our investment loss, if you just look at market value, was, you know, $2.4 million or something. And that's, you know, almost exactly what this difference is. Because with the accounting, you can't use that smoothing technique. So you're going to have a lot of volatility there. One year it's going to go up, the next year it's going to go down. So that's just the way it is. Well, then I'll make you go all the way back to page 18. So with the smoothing, this is your unfunded liability. And last year it was 2,487,000. Well, we make a payment each year to pay that down. That's part of our funding requirement. So we expected it to go to 2,232,000. And if you scroll down a little bit more, Jill, in the end it was 1,894,000. So your gains and losses, your regular experience, that says increase in UAL due to gain or loss. That was an overall loss of 162,000. But there was, you know, 3 pieces that were really significant there. The investment return loss was 236,000, using the smoothing, it would have been a whole lot worse without the smoothing. And then individual salary increases were higher than expected. I think people got raises 10/1/2021 because we compare individual salaries for 2021 compared to the individual salaries for 2022, and they were quite a bit more than expected. So that was a loss of 252,000. And then all that turnover was a gain of 357,000. So we really had a lot of competing issues there. Investment return and salary hurt, and the turnover helped. So we ended up with a loss of 162,000. And then the benefit changes was a gain of 697,000. And then you guys also had done an experience study last year, and we made assumption changes in this report also. So that increased the liabilities by 196,000. So the benefit changes, basically the way that's calculated is we keep a rolling total of the state monies that come in, and then we subtract the extra benefit payments that have been made. So the general employee plan has 2.75 multiplier, and then you guys get an extra multiplier based on state monies. And so we have this rolling accumulation of excess state monies, that we've accumulated more than what we've paid out in extra benefits. But that gets earnings each year. And so we haven't used smoothing in that calculation. So remember how we had the big loss on the investments this year? Well, that reduced our accumulated excess state monies. And that's why we had to lower the multiplier for the members. Remember, in the previous year, we had that good investment year, and we increased the multiplier for the members. And so what I think I'm going to do is, I'm hoping that we get a gain this year on our investments, and hopefully we can increase the multiplier a little bit. And then starting next year, I'll probably start using smoothing of the assets like we do for the funding when we do that calculation for the multiplier. And then hopefully it won't be so up and down every year. Does anybody have any questions about those benefit changes? So then if you go to page 13. So a lot of times we only have two columns here. We usually have on the right-hand column would be the last year's valuation report, 10/1/2021. And then the left-hand column would be 10/1/2022. But we actually have three columns there for 2022, so you can see the impact of things. So the right hand, the one to the right, is if we didn't make any changes. So it would have, the costs would have went from total required of 51.2% of payroll to 48.4% of payroll if we wouldn't have made any changes. And that's because that third line, payment required to amortize the unfunded, well, that payment actually went up slightly as a dollar amount, but remember your payroll went up quite a bit by hiring those new firefighters. So that's why it went from 26.2% of payroll to 23.2% of payroll. So that column there is if we didn't do anything, but the board approved assumption changes, and that actually reduced the funding by 0.6% of payroll from 48.4 to 47.8. Those are the assumption changes that the board approved at the last meeting. And then the far left column reflects the fact that we have to lower the benefits for the firefighters because of that investment loss this year. So I know that was a whole lot of information, but I'd be happy to answer any questions anyone has.
What did that benefit lower to, Patrick, just so that I'm clear?
If you go to page 8. So as of, for the current year, the multiplier is 2.5. I guess I said 2.75 earlier, 2.5 from the city and 0.85 from the accumulated state monies. So it's 3.35 is what you're getting right now. And then next year, starting 10/1/2023, it goes to 3.15% total multiplier. And if you remember the previous year, it was 3.29. So we had went up to 3.35 with the good investment return. And then the terrible investment return this year brought it down to 3.15. Mitchell is going to tell you guys that you're off to a good start, in fiscal 2023, because we had such a terrible year in 2022. So hopefully, we can increase it again a little bit next year, but we'll just have to wait and see how the return does for the rest of this fiscal year.
Hey, Patrick, will you just help me understand, if you'll bear with me? Has it always changed like that? Has it always fluctuated that way?
Well, we haven't had such big swings in the investment returns, as we've had the last 2 years. So for several years, it stayed the same, but it has fluctuated on and off, for a long time. We've been actually doing this. I just looked at the calculation of those excess returns. And it's been since 1984 is when we started that calculation. And, you go up and down year to year, but I think you went almost 5 years without any changes. But you do change periodically.
And then may I ask one more question? When the member retires, is this number permanent or does it change?
It changes. Now that's just the way that it's always been done.
So if you had retired in 22, you'd have been at a 3.35 multiplier, or 21, I mean. The year before that, you would have been at 0.29.
Yeah, let's say you retired 10/1 of 2020. Or 10/1 of 2021, you would have been at 3.29 multiplier. When you got your benefit calculation, we would have looked at your average final compensation times your years of service, and we would have multiplied that by 3.29%. And then starting 10/1/2022, your benefit actually changed. It went up. So if you were getting $1,000 a month before, you'd be getting $1,050 a month, let's say. And then starting 10/1/2023, it's going to go down to maybe $970 a month because it's going to change. So the retirees, they do change every year if the multiplier calculation changes.
Thank you.
So if there's no other questions, then the board needs to approve the report, and then that'll be official for the city, and I'll send it to the state.
Motion to approve the report as presented.
Motion by Mr. Leary,
I second.
second by Sutton. All in favor? Aye. Motion carried unanimous. Thank you, sir.
Sure. So the next thing I think is the rate of return, and that's basically every year when you get your value, approve your valuation, you have to make a declaration of your expected investment return for the next year, the next several years, and the long term thereafter. And you guys actually reduced your assumption from 7.5 to 7.4 in this report. That was one of those assumption changes. And I'm comfortable with 7.4% for the next year, the next several years, and the long term thereafter, because we've been gradually lowering the assumption for most plans because the interest rate was real low and equities had a big run. But now, equities took a dive in 2022. So we're at a lower starting point with the equities. And then now you are getting a higher interest rate on your fixed income. So for those two reasons, I'm comfortable, but I'll see if Mitchell has any opinion from BCA also.
Yeah, good morning. We certainly don't have an issue with the 7.4. We think certainly this year we're on pace. Obviously, there's quite a bit of volatility in markets, but certainly on pace to achieve that 7.4 for this year, and over the longer term, we think that there's a high degree of probability we'll be able to achieve that. So no issues on our end.
So then the board should just make a motion that based on the advice of its investment consultant or its consultants, it declares an expected return for the next year, the next several years, and the long term thereafter of 7.4%.
We'll entertain a motion as Mr. Patrick stated.
I'll make a motion.
Accept 7.4. Do I have a second? Second. Second by Stoneman. All in favor? Aye. Any opposed? None. Motion carries. Thank you, sir.
Sure. I'll stay on in case anything else comes up.
Mr. Madden. Capital City.
Okay, good morning. Can you hear me?
Sir.
All right, so Dwayne Madron, Capital City Trust. I guess the report is up on the screen. Pardon my head cold from the pollen. If you want to page down, please, to the policy review as of February 13th, you'll notice that we're in order to be cautious about what's going on right now, large cap equities and international equities are underweight a little bit while we go through this interest rate increase and inflation fighting exercise. So being underweight large cap and international, I'm overweight cash, which is yielding 4.3, and I'm overweight bonds, which is also yielding 4 and has a lower downside than stocks. I mean, bonds are cheap right now. Some stocks are still expensive, some are not. We're working our way through a slow economy, maybe a recession, maybe not. Layoffs are happening. Some companies are reporting good earnings, some are not. It's sort of a mixed bag. It depends which part of the economy you look at. However, my goal is to be even with Burgess Chambers' strategic model soon, and that may be June. Hopefully he will stop raising rates in May, and that's kind of a green light for the market to move forward because there's more certainty. So a little bit defensive right now, overweight in cash, overweight in bonds, underweight in equities, especially international, where the Ukraine war and the central bank tightening in Europe is happening. So just a little bit cautious, but pretty soon we'll be back to a normal allocation, maybe in June. Any questions on the allocation? If not, we can page down to the performance for the fourth quarter. Now, this is through December. And the year to date, by the way, is the fiscal year to date. As you'll notice up top, it says fiscal year ends September. So the year to date is fiscal, but the 1, 3, and 5 is not. So as you can see in 2022, equities lost 18%. Bad year for equities. Bonds that we manage on our side are down 8%. And real estate was down 25% because it got hurt by rising rates and poor market conditions where companies are not expanding as like they used to. But year to date, it's up 7.6, which is a great start. 8.5 for equities, outperforming the S&P 500. Bonds 5.3, outperforming the Bloomberg aggregate. Real estate jumped back 4.3. So the fall was a quarter where we saw a good stock market in October and November and a bad one in December. It was sort of a mixed bag where inflation was starting to level off and come down, but investors saw where the economy was going to slow down at the same time. So December, they threw up their hands and said, we're not really sure what's going to happen. And December ended with a dud. So, but anyway, the latest quarter was 7.63 as of December, which is good. So if you want to page down and we can look at the returns through January. January was a great month. So year to date, fiscal year to date, you're up 15%. The stocks are up 16.6, way ahead of the S&P 500. Bonds are up 8.4, which is a good return. And then the real estate jumped back 15%. So January was a terrific month. So we're out of the gate on schedule to do well. And we sort of expected that because equities were oversold and starting to get cheap. But we'll see what happens going forward as the economy slows down. We're going to see how earnings shake out this summer because a lot of forecasters think we're headed towards a soft landing or a mild recession. And you can see every day in the news, somebody is laying off thousands of people. So we're going to see how this pans out. But right now we're doing okay as far as the fiscal year to date goes. Any questions? If you want to page down to the asset allocation, this is as of February 14th, and we're 61% in equity. And this is not including the private real estate or the infrastructure. They're probably more closer to 68 if you add that in. But it's a moderate growth portfolio. It's not aggressive. It definitely will do better in up markets than most plans, I believe, because you've got a lot of asset classes that do well in good economies. You want to see what you can see where cash is yielding 4.09. That has since gone up to 4.3, which is a good thing. We haven't seen cash earn that much in a while. In fact, last week I bought a CD for 5.4. That's amazing. I haven't seen that in a while. So if bonds can earn 4 and stocks can earn 9.5, you probably would meet your 7.5% goal. If you page down, you can see the positions in the portfolio, which are mutual funds, Fidelity, Midcap, Vanguard Institutional Index, where most of the money is. That is the S&P 500 index, which is made up of large U.S. companies, successful large U.S. companies, Target, Walmart, Berkshire Hathaway, JP Morgan, Amazon, Microsoft, Google. And you can see we have a little bit in international and developed markets and a little bit with American funds, which is a manager that reaches out to the emerging markets, which can do quite well sometimes. Then we have a little bit in convertible bonds, which are equity-like, Page on down, please. And then you see Sawgrass's market value, Vanguard high yield bonds yielding 5.2. That's really all I have to say. Any questions, please?
No, sir, I don't think so. Make a motion to accept the.
Make a motion.
Second by Soden, on favor? Motion carries. Thank you, sir.
Thank you.
On to purchase PCA. Mitchell?
Good morning, everyone. Thank you for allowing me to join virtually. I'm going to go ahead and kick it off with our market overview and executive summary. Obviously, there's been a lot going on in the markets, especially as of the last few weeks. So Jill, are you able to pull up that handout that we sent over?
Right here. Yes.
Perfect. Okay. So the first page on that, page number 2, you'll see a fixed income chart, and it shows annual returns for the Bloomberg US Aggregate, formerly known as the Barclays US Aggregate Bond Index, which is what we compare our core bond strategy to. But really, this kind of explains the whole picture of not only why last year was so poor in terms of investment performance, but as well as what's been going on recently with a lot of the bank collapses that we've seen over the past 2 weeks. And so you can see historically bonds have been the safest bet outside of cash in terms of protecting your investments. We've historically only seen 4 other years before last year where we lost money in bonds, the worst of which was down 3%. And unfortunately, last year we were down 13% in bonds, which again is historically the worst bond return we've seen well before the beginning of this index, which was 1976. The next page, page 3, highlights really the reason behind it is the Fed's actions, aggressive actions in terms of trying to fight inflation, increasing the federal funds rate, really from a floor of about 0% all the way up to 4.5%. Through last year, and then an additional hike this current year. As of right now, they're currently meeting and expected to announce another hike tomorrow. It was anticipated it would be a 0.5% hike. It looks like based on what's been going on in the banking sector that it's only going to be a 0.25 basis point hike or maybe even a pause, but most likely 0.25% hike at their meeting today, which they'll announce tomorrow. But that huge increase in interest rates, you can see on the next page, page 4. This just highlights where we were at the end of 2021 from a treasury yield curve perspective. So this looks at all the treasury maturities from 3-month all the way out to 30-year and the different yields you could get. So again, at the very bottom, December of 2021, you can see where the yields were at. And then just pan forward a year later, that blue line at the very top, just a huge magnitude increase in interest rates across the board, over 4.5% on the short end and over 2% on the longer end. And so what does that mean for bonds? If you look at page 5, so when rates rise, when yields rise, the market value of existing bonds in the market goes down. And so if you're holding longer maturity, longer duration bonds, those are impacted more negatively than, say, shorter term bonds. And that's illustrated here on page 5, right in the middle of the page. You'll see that column 2022 return. You'll see that 2-year US Treasuries were down a little over 4%. But scroll down a little bit further, you'll see 30-year Treasuries were down over 33% for the year. And really, that's the genesis of what started the collapse and run on banks over the past 2 weeks. So poor risk management, when we talk about bonds, is typically associated with credit. So investing in bonds that are lower credit and have a higher potential to default, and so not get your money back. But what we saw here was investment rate risk or duration risk. So investing in longer term bonds and not having proper liquidity to cover short-term withdrawals from depositors. And so the prime example of this was Silicon Valley Bank. They had a duration mismatch where they had a significant amount of short-term deposits. And as those depositors started to withdraw high amounts of those deposits, their longer duration portfolio that they were meant to hold to maturity, they had to start selling those at huge losses, whether it's a 10-year portfolio, a 30-year portfolio down 16-30%. Most of those they were hoping to hold to maturity. And unfortunately, to cover those withdrawals, they had to sell those at significant losses. And so as those losses accumulated, more depositors got fearful they weren't going to be able to withdraw money and became to withdraw more and more until it eventually snowballed and the bank was forced into receivership with the FDIC. We saw that similarly with Signature Bank in New York. Their deposit base was mostly crypto firms. And with the huge volatility we saw in crypto last year, many of those exchanges had to withdraw significant portions of their deposits. And so similar thing, a duration mismatch, poor risk management in their securities portfolios caused them to mark down significant losses that they had to realize in order to fulfill those withdrawal requests. And so unfortunately, again, as much as banks want to stress test their portfolios, there really wasn't an expectation that the Fed was going to raise rates over 4.5% in a 1-year period. So they certainly could have withstood a 1%, maybe even a 2% increase in rates, but 4.5% certainly just wasn't sustainable for some of these banks who were taking on more risk to generate a little bit higher yield for their depositors. And so unfortunately, we've seen that ripple through the markets over the past few weeks. The Fed has come out and said that essentially all deposits are safe and that they'll backstop them. I know most mid-sized regional banks have requested at least a 2-year backstop by the Fed, and so we'll see if that's necessary. But as of right now, it seems like the market's stabilized. We've seen a very strong rally the past 2 days. In terms of your portfolio, what's most important, I did do a deep dive into the individual mutual funds that we hold. And on an overall basis, between the Vanguard institutional, the Fidelity mid and small cap, less than 0.06% exposure between Silicon Valley Bank, Signature Bank, First Republic, Silvergate, and Credit Suisse. Your American Funds Euro Pacific didn't have any exposure to Credit Suisse, which is another bank that had to be acquired over this weekend because of some of its shortfalls. The FTSE, the Vanguard FTSE, so that's your international index fund, that had about 0.05% exposure to Credit Suisse. And then your Vanguard high yield bond fund had about a 0.64% exposure to Credit Suisse bonds. So overall, if we account for all of that, the total exposure within the plan is less than 0.1%. So if all those positions went to zero, it would only amount to a loss of 0.1% on a total portfolio basis. So I guess the good news there is very minimum exposure looking across your different investments to those various banks that have either failed recently or considered high risk of failing over the next couple weeks. Any questions on that? I know it's a lot of information, but I wanted to at least give you some updates on that and hopefully a little sense of relief that we're not significantly exposed to any of those areas. All right, and then in the handout, so one area that we're positive on and looking forward to this year, it's already been an outperformer in the fourth quarter, and it's outperforming currently year to date, is on page 7. Specifically, emerging markets look very favorable from a valuation standpoint. So you can see we've highlighted on page 7 the price to cash flow. So what investors are willing to pay price-wise for cash flow of companies in emerging markets. It's significantly cheaper than, say, you go over all the way to the first column, the S&P 500 US large cap stocks. You're almost paying about 50% on the dollar for those price to cash flows compared to what you're paying in the US. And so it's no different whether you look at price to earnings, price to book, price to sales, all those different valuation metrics that investors can use. They're significantly cheaper in emerging markets. And so over the past 3 years, we've really seen emerging markets underperform significantly, really due to a strong dollar. And then over the past 3 years, China's zero COVID policy, which they just started to loosen at the beginning of 2023. So we think going forward, if you look at page 9, the currencies are already starting to turn around for a lot of these emerging markets. Page 10, they have a tailwind of being export-based economies, high commodity prices going into this new cycle. And then on page 11, really just the cyclicality of markets. Typically things that have done poorly in previous years tend to start rising back to the top, again, based on valuations being sold off, being unfavorable. And so we think after a very tough 2021 and 2022 for emerging markets, 2023 may be favorable for them. And so if we go to page 14, actually page 15, just to highlight again, one of the areas where we're pretty positive on for 2023 is your American Funds Euro-Pacific allocation. So within that portfolio, they have about 21% in emerging markets and an additional 9% in Asia-Pacific developed markets. That's excluding Japan. And so that 20 to 30% of their portfolio, we think has some favorable tailwinds that should benefit them significantly this year. As of right now, Euro-Pacific is actually the best performer in your portfolio. So year to date through yesterday, it's up just over 4%, just ahead of your second best performer, which is the Vanguard Institutional, so that S&P 500 index fund. And then the other international investment we have, the Vanguard Developed Market ETF, that's up 3.3% as well. So between those three funds, a very strong start to 2023. And then that's all I have for that handout. So we can hop over to the quarterly reports. So the report finishing December 31st. And that is, we'll go to page 5 for that. And if you give me a second. All right. And so you can see we actually had a great start to the new fiscal year as well. So keep in mind, October 1 is the start of our new fiscal year 2023. So for the quarter on page 5, you can see the very first bullet. We earned just over $420,000 for the quarter, or 5.2%. We did trail the benchmark, mostly due to our underweight to domestic and international equities. Again, we're more conservative than the benchmark going into the fourth quarter after a significantly strong sell-off for the first 9 months of the year. And so that rebound that we saw in October and November, we didn't benefit as much. But for the quarter, the best performers were essentially all your international exposures. So the Vanguard FTSE International Index Fund was up nearly 17%, Euro-Pacific up nearly 14%, and then MidCap and your Cohen & Steers Global Infrastructure Fund, those were both up 9.2%. Now panning out to the full year 2022, we were down 1.6 million or 15.9%, slightly behind the strategic model. Really the biggest laggard for the year was that American Funds Euro-Pacific Growth. It underperformed its benchmark significantly. And really the positive areas of the portfolio were really anything that didn't lose money. So cash was up about 1% for the year. And then the biggest protection in your portfolio was that Cohen & Steers Global Infrastructure Fund, down just 4%. And then your high yield bond fund, the Vanguard High Yield Bond Fund, down 8.8%. Panning out longer term, so for the past 10 years, you've generated 4.6 million in investment gains, or about 6.3% net of fees over that period. And then if we pan over to page 8, just quickly highlighting here, these are those numbers I went over. But again, if you go all the way to that far right column, 4.6 million in investment gains over that period, 6.3% return on an annual basis, net of fees. What's pretty incredible is I pulled up the report for the year prior. So the report ending December 31st, 2021. And it's incredible to see that for the 10-year period, we went from 9.9% annualized for the 10-year period ending 21 down to 6.3% for the 10-year period ending 2022. So 2012 was a very strong year that we rolled off, and then obviously 2022 was a very tough year that we've added on. And so just to highlight how much difference a 1-year period can make. Quickly, just to update you as well, in addition to the 5.1% gain that we had for this quarter to start our new fiscal year, we're currently up between 1% and 2%. My calculation was about 1.5% for the current quarter we're in, so January 1 through yesterday. And again, that's based on updates for all the individual mutual funds and ETFs, and then using some proxies for our private real estate and our fixed income portfolios. So with that, up in the range of about 1.5%. So on a fiscal year to date basis, up about anywhere from 6 to 7% to start our current fiscal year 2023. Assets, we finished the quarter at 8,718,000. We're currently at 8,797,000. So an increase for the current quarter we're in of about 90,000. Any questions on that?
So I just had a question about how we're comparing with plans like ours. Are we tracking right along?
I'm sorry, could you repeat the last part?
How are we comparing with plans like ours? Is this just something that we need to ride out, or is it kind of the way it is, or?
Yeah. I mean, so again, last year there really was nowhere to hide. Equity markets were down 18 to 19%. Bond markets were down 13%. Alternatives didn't fare much better. We did add private real estate during the year, and unfortunately, while it was the best performer on a 1-year basis from an asset category standpoint, for the fourth quarter, we actually started to see the cracks in private real estate come through, especially within the office sector. So from a plan standpoint, you're certainly in line with your peers. Again, if we go to page 12, you can see your rankings at the very top. So we did dip below the median of our peer group for this period. But looking back at the end of 2021, we were ranked in the top 25th percentile on a 3-year basis. We're ranked in the top 45th percentile for a 10-year basis. So really just the timing of our private real estate allocation, not being in it sooner and then adding it a little later, unfortunately hurt us more in 2022. So you'll see on page 13, American Core Realty was down 5.4 for the quarter. But the asset category itself, based on the index, was up 7.5% on a 1-year basis. So unfortunately, just some tough timing there that we weren't able to add that a little bit sooner and capture some of the appreciation we saw for the first part of 2022. And that dragged down the portfolio a little bit for the fourth quarter. But we think going forward, really just starting to get back closer to targets. So international, domestic equity slowly starting to get back to our targets. We think that'll be favorable going forward.
Thank you, sir.
Absolutely. And then with that, I will just quickly finish on page 18. And so if you look at page 18, this is where we can kind of look at some of the more in-depth factors and statistics behind the portfolio. And the big one I'd like to point to is for the 5-year and the 3-year periods on the far right side of the page, you'll see that your total fund compared to your strategic model, you've still generated positive risk-adjusted returns over both the 5 and 3-year period, despite how bad 2022 was. So that alpha number, that's any performance that's generated above the level of risk you're expected to your portfolio is taken. You have positive alpha for both the 3 and 5-year periods, despite 2022 and the significant sell-off. So again, we think the structure of the fund is fine, especially over the long term. Just weathering 2022 and rebounding in 2023 will be key. And then with that, I will conclude my report and open it up to any questions. All right, thank you.
Good. Make a motion to accept the report for emergency.
Motion to accept emergency report.
Motion to be by Mr. Leary, second on voted. All in favor? Aye. Opposed? Motion carried. On to Ms. Parrish.
Good morning, everybody. The first memo that I will discuss is the Secure 2.0 Act. This was signed into law on December 29th of last year. The goal of this legislation was to improve retirement savings opportunities for workers with an emphasis on public safety officers. So, we are happy with these new implementations. The bullets here are just a few highlights. Notably, the Secure 2.0 Act will permit first responders to exclude service-connected disability pension payments from gross income after reaching retirement age, really just trying to increase savings opportunities. Another thing to note on the second page is the required minimum distribution age has been increased from 72 to 73, and that was beginning January 1. So as members, get older, we need to make sure that we are releasing the minimum distribution, once they reach that age. Important to note, it will increase to age 75, but not until 2033. So 10 years till that, but, just things to keep in mind in the future. But, we're happy with these changes and just wanted to keep everybody updated on new things that are coming into play. Then the second memo is regarding maintaining internal controls to protect against fraud and abuse. Late last year, there was a longtime pension administrator who was arrested and charged with theft of pension funds. That investigation is currently ongoing. This was a longtime member of the plan. He really had complete control over all of their internal controls. He was reallocating benefits for members who had passed. He wasn't reporting their deaths, and he was reallocating those benefits to himself in various accounts. And this had been going on for a number of years. Finally, there were some red flags from the bank who got in touch with the city, and that's how this all unfolded. I think they're still trying to investigate, just how much money he did take, but certainly in the millions. So these are just some recommendations from us on things to keep in mind. I think we went through this, that with the other funds, Jill, has some of these in place. Specifically, in order to get a check out, Jill is not the only one signing. I believe it has to come from your custodian. So things to keep in mind, that there are, one person doesn't have control over any, major things in the office. One area that we are kind of shedding a light on is the death checks, which is utilizing a service that will update you, kind of cross-referencing with Social Security, so that payments aren't being made to members or beneficiaries who have passed away. Once that money is paid, we can certainly ask for it back, but it's really difficult. And sometimes you end up spending more trying to get it back than was overpaid in the first place. So we're hoping to avoid those issues by utilizing these companies. And I will be getting some quotes for all the funds to use together. So hopefully you can utilize that, while getting a bit of a deal, since it would be the 3 funds splitting the one program. But if there are any questions about this specifically, or, any discussion we want to have with Jill about things that are currently implemented.
As Anna said, we do have a second signature any expenses that are made, whether they're contribution withdrawals from members or whether they're invoices from birds from the banks or anything, that's all second signed. So,
Mhm.
I don't personally cut any of the checks. They're cut by the banks themselves after they receive the authority from myself and the second signer. So, the death checks we do every year. We send out a letter to all the retirees asking them to have this letter notarized because it's a proof of their being alive, is the notary. But that's once a year. We have had just an incident a couple of months ago in the police pension fund where a retiree had died and no one had notified anybody for 4 months. And so he continued to get his checks for 4 months. Once it was recognized by the rest of the family, they ended up calling me and saying, hey, there's something fishy going on here. And it was exposed that this was going on, and they worked with the other members of the family to give the money back to the pension. But that would have been an issue. And the banks themselves have checked the Social Security Administration death master list, but it's not always right and it's not always updated. I've had one person on the list who is a retiree who is very much alive. And I've had multiple who never made it to the SSA list at all. So a subscription based, depending on the dollar amount for that. And if we could divide it among the 3 pensions, like Anna says, it might be worthwhile. But we'll have to see what it costs.
Yes, so that's information that I will have prepared for you for the next meeting.
Was that incident, was that person still living in Putnam County?
Yes. But not all his family was. They were an estranged family, and somewhere up north, and there was one down here.
I just saying we have people check obituaries on a daily basis.
Yes, yeah, we do. Yeah. Yeah, the city clerk actually.
Other transactions. Talk about dual signatures on the checks, or are any transactions handled by wire or ACH or that, or are they all paper?
Everything that is paid out is paper based.
Okay.
Now, the transactions themselves happen via wire between the banks, but it's initiated based on paper based.
Who would the second signer be, Ms. Jill?
Right now, it's the city manager. Going forward, as he's leaving and we have no city manager, it's becoming the assistant city manager, Jonathan Griffin. But that all has to be changed at every bank. For the ARA, for the Cohens and Steers, all of them have to get new signed paperwork every time it changes.
So the only other item under myself is at the last meeting, we discussed a addendum to the investment policy statement to reflect that we want to tell our investment managers how we would like them to vote regarding the personal liability for directors and officers. After discussing with Jill, we realized that the ordinance hadn't been previously updated with a prior change. So I drafted a new ordinance addendum and sent it to the city manager, which basically says that the fund has the authority to adopt rules regarding an investment policy statement, so that every time there are changes going forward, we won't have to update the ordinance. And realistically, you would have to update the ordinance prior to implementing the change so that we weren't in violation. So as soon as I get feedback from the city manager, I will let Jill know, and hopefully this can get on the agenda for the next meeting, for the next city council meeting. And that is it from me, unless anyone has any questions.
Is the end of this month is when our city manager will be done.
The city manager has a contract until May 14th. However, he may not be here till May 14th because he has a fair amount of paid time off that he's might use.
Gotta use up his sick days.
Yes.
So then this would just fall to the assistant city manager then?
Yes. Yes.
Oh, so I wonder if my email, although you said the city manager, not the city attorney, so we should be fine.
Actually,
Yes, if you send it to me, then I can ensure that it'll be on the next agenda.
Okay, I had sent it to you and then realized today when I was going over my meeting materials that it was sitting in my outbox. So I just resent it today. So hopefully you'll have received that.
Okay, thank you very much.
Thank you. Sorry for the delay.
Some motion to accept Ms. Parrish's report.
Motion to accept.
Second. By Stover. All in favor? Aye. Motion carries. Thank you, ma'am.
Thank you.
Expenditure.
yes, the expenditures are up on the screen. Nothing unusual. We have a new expenditure for the ARA, the quarterly expense. That's the real estate, the private real estate that we've signed up for since October. But otherwise, pretty traditional expenses.
Motion made by Lindsay. I second. That's on there. Motion carries unanimous. The public comment, children, public comment.
No public comment, and the other business is just the email addresses that you now have for your Form 1s that Sunny talked to you about. Those who didn't have City of Palatka email addresses, those on boards now have them. Our next meeting is on June 6th. It will be at the normal time. The other meetings are all moved up a couple of hours because we have to be out of here earlier. But this one being the first meeting is going to start at 10 o'clock, just like normal on the 6th. And that's everything.
If there's no other business, motion to adjourn. Second by Stover. Thanks, guys. Thank you.
Hi, guys. Nice to see everybody.
Thank you, sir. Appreciate your time.
Thank you. Nice to see you.
Thank you, sir.
Okay, bye, everybody.
Have a great day.
Thanks, you too.